Trade barriers are rising just as the EV industry needs flexibility to navigate this transition. Second, Tesla's pivot creates massive opportunity in affordable EVs, mostly international. Third, companies with flexible manufacturing, they're going to be more resilient when it comes to things like tariffs and external pressures. Third, while AI remains important long-term, companies are still going to need to have somewhat of a focus on affordable EVs today. As a NIO investor, I remain optimistic. The current industry disruption creates opportunities for nimble, forward-thinking companies like NIO with its focus on technology, battery innovation, and user experience. What's going on, everyone? My name's Obi and welcome back to the Courtside Financial podcast, the podcast where we talk about business and technology as unbiased as we can. In today's episode, we're going to be talking about two things that are kind of shaking up the automotive industry as far as headlines. We're going to be talking about Trump's new tariffs again, and then we're going to be talking about Tesla's dramatic pivot to AI. No need to waste any time. Let's dive right in. So the 25% tariff that the Trump administration imposed on imported vehicles definitely sent shockwaves throughout the market and has shaken up the automotive industry seemingly right away. Jaguar, Land Rover, and Audi have suspended U.S. shipments. Mercedes is considering pulling entry-level models, and Ferrari has already imposed a 10% increase due to the tariff. But here's a surprise. American automakers are panicking too. Tesla's stock plunged 21.5% just in 4 days, wiping out nearly $200 billion in market value. GM dropped 7.36% immediately when tariffs were announced, and Ford CEO he called the policy devastating. Why? Because American made is largely a myth today. About 60% of parts used by American cars are coming from overseas, and for Tesla, it's 65%. These tariffs hit parts too, raising cost per vehicle by anywhere from $3,500 to $12,000. Consumers are rushing to buy cars before the price jump, with March sales up over 13% year over year. Meanwhile, Goldman Sachs has already lowered its U.S. annual sales forecast from 16.25 million vehicles to 15.4 million vehicles. This situation reflects decades of global integration. America once dominated the automotive manufacturing industry. By 1962, U.S. production exceeded 8 million vehicles, more than Germany, France, and Britain combined. But the 1973 oil crisis exposed American automakers' over-reliance on gas-guzzling cars, while fuel-efficient Japanese models went ahead and took market share. When the US pressured Japan to limit its exports, Japanese brands adapted brilliantly. They created luxury brands like Lexus, and they built US factories, but they discovered that American manufacturing costs were about twice as high as Japan's manufacturing costs, and also with lower productivity. So they imported the most critical components, only doing final assembly here in the US. American brands did the same thing in reverse, outsourcing to Mexico and China. Today's least American cars include Ford, Buick, and Lincoln. The UAW union complicated things even further. In 2007, GM spent $73 per hour per employee as a UAW member. At the same time, Toyota was spending about $48. To compete, American automakers moved operations abroad, with Mexico now supplying over 42.8% of U.S. auto parts imports. Meanwhile, aside from all this tariff talk, Tesla is facing its own challenges. They've now terminated, allegedly, the plans for the Model 2, the more affordable vehicle. And why are they doing this? They're doing this to bet everything on robotaxi and AI, allegedly. This wasn't a unanimous decision. 3 executives who opposed this decision left almost instantly, around within 6 weeks of it. Some analysts suggest that robotaxis could be under 1 million units across all competitors annually in sales, nowhere near enough to replace Tesla's over 633,000 US annual vehicle sales. If robotaxis are priced at 20,000 to 25,000, they could generate 3 times their annual sales price in lifetime commissions, but expansions of production face lots of regulatory hurdles. People close to Musk say he simply lost interest in traditional EVs, investing $10 billion in AI while Tesla's product line ages. After growing 50% annually from 2019 to 2023, Tesla's sales fell by 1% and dropped 13% in Q1 2025. The stock price has halved since December. If you want to be a part of the conversation before it happens here on YouTube, click that link in the description to join the free Courtside Financial Discord. What does this mean for NIO and other EV makers? Well, I see 4 key takeaways. First, trade barriers are rising just as the EV industry needs flexibility to navigate this transition. Second, Tesla's pivot creates massive opportunity in affordable EVs, mostly international. Third, companies with flexible manufacturing, they're going to be more resilient when it comes to things like tariffs and external pressures. Third, while AI remains important long-term, companies are still going to need to have somewhat of a focus on affordable EVs today. As a NIO investor, I remain optimistic. The current industry disruption creates opportunities for nimble, forward-thinking companies like NIO with its focus on technology, battery innovation, and user experience. That's all for today's episode of the CF Podcast. Wanted to give you guys a quick update. Let me know what you think about it. Leave a comment down in the comment section below, and don't forget to join the free Courtside Financial Discord. We'll catch you in the next episode. Thanks for watching. This is Obi signing off.